are you also zooming it? You said the same thing. Or just
Do you want me to zoom it to everyone?
you texted me, just ask her because she more fuzzy about it.
Okay, can do.
Now that we're recording, I can say that. I love them.
They're great people.
But the reason I asked to come in person is because some things are just better and more effective in person. We had a discrepancy with some folks not knowing exactly how much one does or doesn't need to do a conventional loan versus an FHA, et cetera, et cetera. And if you can't speak to those things, the short answer, if you can't speak to it, and somebody says to you, I can't get a conventional loan, I don't have 20% to put down. Well, let's say you're unsure if that's the answer. You say, you know what? My preferred lender to our team, he has some really great programs, sometimes often creative programs we don't even know about. I would encourage a conversation with him. May I have Marcel go ahead and reach out? That's the answer, right? It's never, I don't know, or it's never, oh crap, no, you can't get a loan. Right?
And a lot of my time is educating people because people aren't educated on the home buying process, regardless of what level of education they have. It doesn't matter. Generally, when they're out buying a house or selling a house, even if they've done it maybe 2 or 3 times, they're in a learning process. They don't know the rules. They have no idea of exactly what's changed over the past 2 years, 3 years, 10 years. And so really it is an educational process. So anytime that I'm talking to any of your clients, even if you say, hey, please reach out and help them get pre-approved, that's not my initial goal. I typically reach out and just try to answer all their questions. I ask them where they are in the process. Do they have a specific home they're interested in? Are they just trying to get some mortgage questions answered? Because people don't want to be sold. They want to be educated. They want to know what it is that they need to know about this home buying or home selling process. And in their mind, all they know is that, it's a lot of money. They're spending tons of money that they've been saving for a long, long time. So it's hyper important to really have those questions answered. Let me grab you a notebook. Here you go. So just to kind of reintroduce myself, Marcel Dietrich with Guaranteed Rate. Been fortunate enough to have worked with Christy and Kevin for technically 10 plus years is all I'm supposed to say, but we've been working together for quite some time. So been really fortunate. I see myself as kind of a resource for all of you. If you ever have questions, even if I'm not the mortgage company who is currently working with your client, or they come to you and they're pre-approved with someone else, feel free to reach out to me to answer questions. I'm happy to help answer things. I can't tell you how many transactions I've solved where another mortgage company is actually involved and I get a call. We're supposed to be closing in 3 days. X, Y, and Z is happening. Marcel, how can we save this? I'll reach out to the other mortgage company, give them some direction. I'll talk to your clients, even if I'm not the loan officer that's working on their transaction, because at the end of the day, I want to make sure that you're as successful as you can be. And that means obviously helping as many clients as possible. So before we get started, I always like to have kind of just an open Q&A. If there's any specific issues that you maybe are working on right now with some of your clients, whether it's with FHA financing, VA financing, USDA, land loans, jumbo, anything specifically I can address for you. Go ahead.
I have 2 nurses actually that want to move to the area, but they don't have jobs yet.
Okay.
Is there any way to get them approved without?
Great question. Yes, a lot of the programs, VA loans, conventional loans, FHA loans, they all will allow someone to actually close on a transaction before they start their job. And I do a ton of loans for medical professionals specifically that are moving. So here's what happens. They may end up getting a job for X, Y, and Z hospital. They'll end up getting a letter. It'll have their income, it'll have their start date, and then it'll have contingencies on there. Typically that means background check. In the medical profession, drug screening is almost always on there. So what we do is we actually have the HR department update that letter, removing those contingencies after they pass their background check. After they've passed their drug screening, then they can issue a new letter, and with that, they can actually close before they start their job. Now, with nurses, it can sometimes be a little tricky because sometimes they might work for an organization that is going to just pay them W-2, and they're working specifically for the organization. That's the easy road. Sometimes they're working for staffing companies. There's lots of staffing companies out there, Staff Care, Locum Tenens Care. There's so many different companies out there that sometimes will put people into a position for maybe 6 months, 12 months. They have some short-term needs. That becomes more problematic unless they have a history of working for that company for an extended period of time. So anytime that someone is moving here to the area and they're thinking about, okay, I'm changing jobs, how is it that I'm going to be able to get financing? I make sure that I give them the right questions to ask their employer, because it might be that they have multiple ways they can set up their employment. You know, it might be that they have an opportunity to work as a W-2 employee, or they might be on contract work. Well, if they have a history of contract work, that's fine. If they don't, they need to know that they have to have that 2-year history in order to move forward. So yes, the simple answer is yes, you can certainly start your job after you close on a home, but you have to talk to someone ahead of time to make sure that that employment is going to be structured properly. Otherwise, they might end up putting down a significant amount of earnest money, then finding out that they're not able to get approved and potentially lose that earnest money or worse. So, it definitely can be
But
problematic.
without having a job secure, there's no way.
Correct.
I can't come here if they
I don't want to say no way. There are some loans that are out there that are called asset depletion loans. And so that means that if this nurse has $1 million sitting in an account right now, we can actually use that as their income. So in essence, we can take that money and divide it by whatever the time frame is that you're having to do specifically based on their age, but we can use that as income. Now, those are going to be specialty programs. Anytime that you're talking about a specialty program, that in essence means that it doesn't necessarily fit in the box. The interest rates are going to be a little bit higher, but it's much better than not being able to buy a home at all. So yes, you do have to have a job in order to close on a mortgage, unless you have assets or you're doing some other type of loan. There used to be, back in 2001 through 2007, there used to be some crazy loan programs out there that really kind of spurred the entire financial collapse. At one point, we were doing what are called ninja loans. We could do loans for people that had no income, no asset, no job. Ninja, it's an acronym for no income, no assets, no job. It was nuts. Well, that's how we kind of came into that financial crisis, which caused obviously the big foreclosure boom. A lot of people right now think that, you know, are we in the same environment? Is there a housing bubble that's going on? I can tell you, everyone that's buying homes right now are highly qualified. The guidelines are still very, very strict. We're fully documenting income, assets, credit. We are in no way, shape, or form in the same type position that we were in the 2007 through 2009, 10 timeframe. Even though, yes, home prices have obviously gone up significantly, we're definitely not in a housing bubble. Any other questions? That was really good, specifically on your clients that are kind of thinking about moving, because we're all working with a ton of reload clients.
T-Shack just completely got rid of their buyer yacht. Did
Mhm.
you speak on that? That was
Yeah.
crazy.
So there are a lot of unique programs out there. There's T-Shack, TDHCA, Seth. A lot of these programs are constantly changing their guidelines. And so it is very, very important that if you have clients and they initially go through and are trying to get pre-approved for one type loan program, and then all of a sudden, some of these programs sometimes run out of money, or they'll completely stop lending money at all. Sometimes they'll change their guidelines. Sometimes USDA will change the perimeters specifically of where you can use that type of financing. So anytime that you're looking at any type of those unique financing type programs, it's really, really important that your client stays up to date with the mortgage company as to what are the changes and is it going to affect me. Right now, we're seeing this with clients that have maybe been looking for a home for 2 months or 3 months. Well, interest rates were a lot better then. So what happens when interest rates go up? Now, all of a sudden, that pre-approval letter isn't really worth anything because that interest rate isn't still available. So it's really important to know that. Also, if you have clients that are going through the new build process, make sure that they end up locking their interest rate with either the builder's in-house mortgage company or another mortgage company for the long term. There's long-term locks that are up to 12 months that are out there. There's 2 different ways that those locks can be structured. They can be structured with money up front or no money up front. No money up front typically means that the interest rate is going to be higher, but it locks in the interest rate. So let's say hypothetically right now, you have a client and they are starting the new build process, they're under contract, and they're going to be done in, let's say, 9 or 10 months. So they're in that position now to where they're waiting out the entire build process. Have them get in touch with the builder's mortgage company, lock in that interest rate without paying additional fees up front, regardless of what that interest rate is. Why is that? Because you're creating a worst case scenario for them. So for example, let's say that right now to lock in for 12 months, the interest rate is going to be 5.75%. Sounds horrible, doesn't it? I mean, 5.75% is not a good interest rate at all. Lock it in, it didn't cost you anything at all. What if a year from now, interest rates are at 6.5? Are they going to be happy that they got that 5.75%? Yes. Also, they need to go ahead and set their expectation as far as where the monthly payment is going to be at that 5.75%. Because if they haven't locked in the interest rate, two things can happen at the end of that build cycle. One, they may not qualify. How horrible would that be? If you're working with a client, you're constantly going up to the house, you've done design center work with them, you've really seen them fall in love with the property, and then all of a sudden, they can't get it because interest rates have gone up and they haven't locked in that rate. That is absolutely horrible. Now, in this environment right now, the builders are happy about that. They're like, yeah, I'll just resell that house. It's completed. I'll get it sold over the weekend for $100,000 more. You'll get it sold quickly, but you want to protect your clients. So when you're working with new build, have them lock in that long-term interest rate, regardless of how ugly it is. Lock it in. If they're not paying money up front, then there's not going to be an obligation to move forward with that specific loan, but that creates the worst case scenario. Set that as the expectation of your monthly payment. Set that as the mark where you know that you're going to be able to get pre-approved, and then hopefully interest rates drop. Are they going to drop? Probably not, but there's certainly always that opportunity for interest rates to drop. So when you're working with new build, always lock in that long-term interest rate, because you don't want to work with a client for a year and then obviously have the transaction fall out.
Do you guys know what T-Shack and?
No, I was,
Okay.
that was one of my questions.
Okay.
I had, like,
So
another one.
what question specifically on T-Shack?
They don't know what even T-Shack is.
Okay.
So
Yeah,
they just
as
go-
you were talking, you named off like 3 different acronyms
Sure,
or
sure,
something.
okay.
and
So there's a lot of different programs that are out there that they subsidize either closing costs or down payment. So T-Shack, TDHCA, SEF, they're often termed for first-time home buyer programs, because oftentimes they will actually give assistance, sometimes to specialty groups. There's specialty programs for teachers, firefighters, any type of city workers, and they're first-time buyer programs. They're great programs. The interest rates are a little bit higher. The problem that we're seeing right now with them is that in an environment to where someone's buying their first home, oftentimes they're going to need an additional $20,000, $30,000 in order to even have that contract accepted. And so with that, obviously there can be some issues if they're trying to do that first time buyer program. They don't have that extra money. So we're not seeing a lot of T-Shack programs. We're not seeing a lot of SEF, TDHCA. We're not seeing a lot of those first time buyer programs, because right now, unfortunately, first time buyer programs, it seems like they're not being priced in the market. Even if the seller would accept it, the clients don't have that $20,000, $30,000 to
Only
make up.
place I'm seeing it is new builds. So that
Absolutely.
happened on Wednesday, it was Wednesday,
Mhm.
all of a sudden the interest rates were at 3.75, and then they jumped to like 5.75. So people who originally were my clients who were
Mhm.
originally going to be doing this program, because they only had 20,000, they didn't really have anything to put down.
And that's what happens when you're talking about programs like T-Shack, TDHCA, and SEF. They don't adjust their interest rates on a daily basis like the mortgage market does. They adjust them sometimes on a monthly basis, which means that if a month ago interest rates were in the 3s and now all of a sudden they're over 5%, they're going to have that extreme jump. So it can certainly be an issue.
Are they already over 5?
Interest rates right now are not yet over 5, but they're going to
I
be
was
there
gonna say,
very,
I
very
was like, I
quickly.
didn't think we were already at 5, but maybe I
So
could.
for
my client's pre-approval letter, the expiration date's not expired, but I need to look at that because they're gonna have to read.
Correct. Because
Going-
keep in mind, anytime that you're looking at that letter, it typically is going to have an interest rate that it's based on. So when you're submitting offers, or let's say you're receiving offers on the listing side, if that pre-approval letter has an interest rate on it of 3.5, that may not be available. So you want to make sure that, hey, does your client know that those interest rates have certainly gone up? So it's definitely something to look out for right now.
You
Like
say
on a weekly basis.
Oh, absolutely.
You say may not be available, but 3.75, like we're not there anymore, right?
No.
Like, okay, that's what I thought, but you said may not be available, so I'm like, let me make sure I understand that correctly.
And there's always some ARM programs that are out there, adjustable rate mortgages. Sometimes people are very hesitant to use an ARM program because they remember what happened in 2007, 8, 9, and 10. ARM programs aren't awful, We work with a lot of clients that are working in the IT field, and so they might be coming here and they might have a job doing contract work for Raytheon for 2 years, and then they know that they're going to get moved somewhere else. They're like, I don't need a 30-year. A 5 year is fine for me, and the interest rate's going to be better. So sometimes ARM programs can certainly still be workable.
Back to the new builds, when you were talking about locking in the rates. If interest rates were to go down, do they still do the float? You were talking about a float on your call. Can you do
Correct.
that with?
Absolutely. So
Okay.
our programs allow for a one-time float down option. Now that's on the extended locks as well. So one time during that process, if interest rates do drop, your client can actually float down.
Are you limited on how many locks you can do as a?
On the float down option, you have one time to float down. The reason for that, if you allowed clients to float down every single time that interest rates move, clients would call up every single day and say, did the interest rates move? Did they move today? Did they move today? Did they move today?
What keeps that client from like going somewhere else and relocking with the new person?
Nothing
If
at all.
You can't.
They most certainly can. And that's why the float down option is something that we Guaranteed Rate really push, because we don't want to work with a client and then obviously have them go somewhere else. And if y'all don't mind, I need to go blow my nose real quick. Allergies have been killing me.
Go for it.
Okay, I'll be right back.
Lauren can lead us. Hello, guys. How y'all doing? Well, I haven't met you yet. Renee, yes, Renee. What's your name?
Rebecca.
Rebecca.
Peter.
Peter.
Rebecca and Peter in our Fort Worth office with me.
Yay, that's awesome.
Lauren is a senior agent. She's a shadow-able agent.
Yay.
So if anybody needs a shadowing opportunity and it's coming up, if Lauren has one, that would be a great person to do so with.
I'll let you guys know. I care about Lauren.
You'll let me know because everybody's at different stages.
Yep.
So
Perfect.
some might have an appointment next day, so they can do that.
Yeah, okay, that's perfect. I have a design center appointment tomorrow. I know those are sometimes fun to go on.
Does anybody have a new build contract under contract?
But I
Before you raise your hand, does anybody have anything under contract that's new construction? Have you been to a design center appointment?
What time's your appointment? It is at 9:30 and it's gonna be in the colony. I'll send you all that.
Sorry about that, y'all. Allergies have been killing me. the
It's
past
Can I get
couple
you
of
some water?
Actually, water would be good. What other questions can I answer for you?
I've had non-warrantable loans come up like 5 times now, and I had no idea what it was, so I'm sure a lot of people don't know.
So a non-awardable loan basically is typically going to be on condominiums, and it means that that property is not going to be eligible for any type of traditional financing. So Fannie Mae, Freddie Mac loans aren't going to work on that complex. Thank you. What makes a complex sometimes non-warrantable are going to be if one entity owns too many of the units, meaning over 10% of the units, or a lot of the complex is non-owner occupied. And that means that now the only type of financing that's going to work on non-warrantable are going to be cash buyers or your subprime loans, your hard money loans, those types of things. It can be really frustrating too if you have a client and they end up buying a condo and then 2 years, 3 years down the road, they want to sell the condo and then it's non-warrantable. Now they might not be able to sell it except to cash buyers. So you really want to make sure if you're working with condos, we have a condo class we can do. Let's kind of get on a call and kind of go through that in detail because it's really, really important.
Are you saying warrantable?
Warrantable, yes.
Warrantable.
Mhm.
Warrantable.
Yeah, I've had.
I had to
3 people
Google
look
it
at
the
same
other day when
condo.
she was talking about it. I'm
Yeah.
like, okay.
3 people looked at the same condo, and it's non-warrantable loan, and I was like, I'm gonna try to explain this to you.
And there's a condo questionnaire that can be sent to the HOA company or the management company up front. And that will ask questions like, how many units are owned by one individual? How many of the people in the complex currently are behind on their dues? Are there currently any lawsuits that are affecting this complex? Those types of things.
And that would all play into effect what would make it a
Warrantability, absolutely.
So can you only find that out after?
Well, no, typically, if I were to list a property and it was a condo, first thing I would do is go to the HOA and the management company and have them fill out that condo questionnaire to see. And so as the listing agent, I would let people know up front, I need you to know this is a non-warrantable unit. And with that, obviously, traditional financing isn't going to work.
Which is probably what yours did because he knew up front. It said
They
it in
put
the
it on
MLS,
They put
right?
it on the list saying like this
Yep.
requires
That's
an
good.
unwarrantable loan, but I don't know why.
Which is good because it saves you a ton of time. Because if you know that your client is not going to qualify for any type of hard money subprime loan and they don't have the cash, then that's obviously not a unit to go look at.
Can you speak a little bit more on the subprime loans?
Sure. So, okay. So,
So I know what they are just from school, but like, I don't know how they
Sure.
work.
So subprime loans are also called non-QM loans. These are basically going to be loan products that aren't going to be securitized by Fannie Mae and Freddie Mac. So Fannie Mae and Freddie Mac are the two entities that really securitize about 95% of loans that are out there, meaning it absolutely has to fit in the box. If it doesn't, there are certainly going to be entities out there that can do financing on those. And those are called your non-QM. Jumbo loans, for example, are non-QM. Bank statement loans are non-QM. These are all going to be loans that don't fit in the box. Sometimes when you hear about these loans, you're like, these are the bad loans. They're the ones that got us in trouble. They're the ones that basically put us in a position to where we had that huge financial collapse and that crisis. But really, they didn't start off as bad loans. When non-QM loans really originated back in about 2000, 2001, they were made for high net worth individuals, people that had a 780 credit score, had maybe ownership in multiple corporations. They had a lot of assets, great credit, great income, but they didn't want to go through the entire process of having to document all of their income. Because if you have 300 pages of tax returns, you don't want to turn all that information in. It is a complete beating. It's a nightmare. So companies started out and they said, okay, if you have a 780 credit score and you're putting 30% down and you have, let's say, 12 months reserves in the bank, then we are not going to require us to completely document income. And they weren't risky loans at all. They were actually very non-risky loans, even though we weren't documenting their income. Why? They had great credit. They had 12 months of reserves in the bank, and they were putting down 30%. That's a big down payment. But what happened is other companies then started to mirror that. And they said, well, we'll do this if someone, let's say, just puts down 20% and only has a 750 credit score and only has 6 months of reserves. Then another company came out and said, okay, well, we'll do it with 10% down, 3 months of reserves, and just a 700 credit score. And then you had another company that came out and said, well, we'll go ahead and do this if you have, let's say, 5% down, a 660 credit score, and 1 month reserve. And it went all the way down until we were literally at those ninja loans, to where people said, hey, we'll do loans with no income verification, no assets, credit score doesn't matter. And so non-QM loans by their nature are not bad loans. They're not evil loans. There are some entities right now, for example, with a guaranteed rate, we have Goldman Sachs as one of the investors that we work with. They love doing non-QM loans. Why? Because a lot of high net worth individuals, they have ownership in so many different corporations. They don't want to go through all of that. And so we do have some of those. The interest rates on those are about 0.5% higher than market. But for a high net worth individual, when you're talking about an interest rates that is 0.5% higher than market, that's a lot better than having to provide, those 300 pages of tax returns, having an underwriter ask all sorts of questions. It can really be very, very frustrating. And so by their nature, non-QM loans are not evil. ARM loans are not evil, but what in essence that means is that it doesn't fit to Fannie Mae and Freddie Mac guidelines. So the next thing that you need to understand is, why is it so important to fit to Fannie Mae and Freddie Mac guidelines? Why is that so important? Well, the reason is, and write down this term if you would, it's called mark-to-market accounting. And a short definition of what mark-to-market accounting means is that if there's not a market for the product that you're holding, you have to mark it down to $0. And let me explain to you how this affected the mortgage industry. So back in 2007, 2008, and 2009, you had companies that started doing all of these non-QM loans, where there were two big entities out there that started buying these up at a crazy discount. Bear Stearns and Lehman Brothers. Not sure if you're familiar with the name, but they were very, very large banking institutions that were able to see that obviously the foreclosure crisis had started. There were a lot of institutions out there that literally had billions of dollars in these loans. And so they saw that, homes were depreciating, homes were starting to go into foreclosure. So they said, hey, we'll buy up these loans for 10 cents and 15 cents on the dollar. Because they're like, if it's a $100,000 home, if it drops by 50%, if we only pay 10% for it, we're still in a good position, right? So they started buying up billions and billions and billions and billions of dollars in these loans, which sounds like a really good business decision, because at the end of the day, these homes aren't going to devalue by 90%. That's just ridiculous. There's no way it was going to happen. The problem is mark-to-market accounting came into effect. So what ended up happening is they bought all of these loans, and then truly the secondary market completely froze up, meaning that no one was willing to buy these loans in any way, shape, or form. And so when no one is willing to buy these loans, in essence, that means you have to mark it down to $0. So these financial institutions, the way that they can loan out money is for every dollar that they have as an asset. Let's say, for example, they can loan out 50 cents. So if you have $100 in assets, you can loan out $50. If you have $0 on this loan, you had to mark this asset down to $0. How much can you loan out? $0, right? But they had lots of outstanding loans. So they quickly found themselves upside down in the amount of assets that they were holding compared to the amount of liabilities that were out there. So then what happened is people started making what's called a run on the bank. Are you all familiar with that term at all, run on the bank? What that means is that people become fearful that their money in the bank accounts isn't going to be available anymore. So at that point, the FDIC insurability limit, meaning that how much does the government insure your checking account, your savings account, those types of things, how much are they willing to insure? And at that point, they would insure up to $100,000. So everyone who had over $100,000 in their account started taking their money out. So what does that do to Bear Stearns and Lehman Brothers? That means they have even less money in assets. And so the FDIC quickly stepped in. And if you notice now, when you go to the bank, it'll say FDIC insured to $250,000. That actually happened when the FDIC stepped in, and they're like, you don't need to take all of your money out of the bank. Let's just go ahead and bump this up. But at that point, it was too late. Bear Stearns and Lehman Brothers found themselves in default, and within 2 weeks shut their doors. And these were massive, massive, massive institutions. So what happened after that is all the banks took notice. They're like, okay, well, we see we need to originate loans that conform to the Fannie Mae and Freddie Mac guidelines. Why is that so important? Because at any point, even if the entire market freezes up and you have a loan that fits the Fannie Mae and Freddie Mac guidelines, you can sell it to Fannie Mae and Freddie Mac, meaning that you are never going to be subject to mark-to-market accounting. So banks are very, very hesitant to do that. In fact, a good example I have of that is Ben Bernanke. He used to be head of the Fed probably, I want to say 10, 15 years ago or so. You're talking about one of the chief financial positions in all of the United States. After he was done at the Fed, he went on a speaking circuit, and he started speaking at universities, at commencement addresses, those types of things. And he tried to refinance his house. Because he didn't have a 2-year history of refinancing his house. Now, granted, every time he spoke, he was making $150,000, $200,000. He didn't have a 2-year history, so it didn't fit in the box. It didn't fit in the Fannie Mae and Freddie Mac guidelines. And you can look it up on Google. He was denied a refinance loan because it didn't fit in the box, because people were not willing to do a loan that did not conform to Fannie Mae and Freddie Mac guidelines, because it creates so much risk for people. And literally, after that happened, really in 2007, 8, 9, and 10, the mortgage industry completely changed. It had nothing to do with common sense anymore, had nothing to do with rational thought. It had everything to do with, does it fit in a box? And I remember, and I taught over in the Keller Williams Frisco office. I was there for 13 and a half years. And I had a client one time. He was a vice president over at one of the larger corporations over in Plano off Legacy. And he had just retired. Now, this was after kind of the stock market had collapsed. And so he said, I don't want any type of pension from my company. They were going to pay him, X amount of dollars, or he could have a one-time lump sum payout. Guess what he opted for? One-time lump sum payout. And he wanted to go buy a house. At this point, I think he was buying a house for like $950,000. Back then, $950,000 was huge. It was insane. Now I know it's like a more standard home almost, but literally he was wanting to buy a house. He was putting like $500,000 down, but because he did not have that income piece in place, he wasn't able to get a loan. And he had like $3 million in the bank from his one-time lump sum payout. So cash is obviously always an option, but that's why it's so important to know kind of why it is that these mortgage companies sometimes are so strict with their Fannie Mae and Freddie Mac guidelines, because literally mark-to-market accounting means that if you're doing a loan and it doesn't fit in those guidelines, you have the potential to be holding a loan that you have to mark down to 0 on your books. And that's very, very scary for financial institutions.
Quick question. So you're saying, I just want to make sure I'm processing this. Because most of the time your loan is bought by
Mhm.
someone. So you're saying no matter what, that's why we try and fit it in the Fannie Mae and Freddie Mac so that they at least would buy it.
Absolutely.
Okay.
It's
Just wanted to make
basically,
sure.
it's a safety net for
That's cool.
institutions, because at any time, if you originate a loan and it fits the Fannie Mae, Freddie Mac guidelines, at any point,
Ditch it off the books.
yeah, absolutely. All of a sudden, you need to get that loan off the books and you can sell it to XYZ. You can sell it to Bank of America. You can sell it to Wells Fargo. You can sell it to any of these companies, because to them, it has value as an asset because it meets the Fannie Mae and Freddie Mac guidelines. That means that whoever is servicing that loan always is going to have the opportunity to, worst case scenario, Bank of America, Wells Fargo, Chase, everyone says, we're not buying any more loans. You can take it. Fannie Mae and Freddie Mac will buy it.
That's why, despite the common sense, if Marcel makes $4 million a year and has $10 million in assets,
That would
tries
be
to get a
nice.
mortgage, and he tries to get a mortgage on a 13-acre property, they're gonna tell you what?
No,
You're like, but wait, that doesn't make any sense. Like common sense would tell you like, hey, oh, by the way, he's even putting down 400 grand
Mhm.
on a $1.2 million house, and they're gonna tell you,
no. And that's the problem, is that there isn't any common sense in any type of underwriting guidelines. Now, the good news is that, you know, there are institutions now
there are
that
places we can turn.
yeah, that will do some things that are out of the box. And again, it's one of the reasons why the way the guaranteed rate is structured is that we have correspondent relationships with a lot of these institutions. So internally, we have access to 87 different institutions. A lot of those will be your household names, your Bank of America, your Chase, Wells Fargo, Goldman Sachs, and a lot of other institutions. The reason we have access to so many is because every institution does loans based upon different variables. And so some give discounts for vocation, some give discounts for employer, there's some that'll give discounts for high net worth individuals, but more importantly are for kind of those out of the box clients. For your clients who maybe are a non-QM or potentially hard money loan, but Marcel, they're great buyers. They have 780 credit scores. They've got tons of money in the bank and they're putting down 30%. Goldman Sachs is like, that's who I want as my buyer. Why? Because if they do the mortgage, then there's a higher probability that they're going to end up doing other business channel arrangements with that client. Maybe they're going to start investing in stocks with them. Maybe they're going to start doing some commercial type financing. So Goldman Sachs, that's what they want. They want those high net worth individuals. They want people who understand, hey, listen, it's important to have great credit. It's important to have a lot of assets. On the income side, we know you have it. Otherwise, you wouldn't have all this money. But there are certainly some ways to kind of work around that. And that's why it's so important for us to have access to those institutions, but to also do so on a correspondent basis. And so what that means, Tiffany and I actually had a really good conversation about this about a week ago or so. But what correspondent means is that we actually have our underwriters licensed to underwrite for these institutions. The worst thing that I hate is anytime, and I've done this before in the past, you broker a transaction. What that means is that you take a loan, you send it off to another institution, you keep your fingers crossed and hope that everything goes well. That's horrible. You don't have the internal control. So by having our underwriters licensed to underwrite these, if needed, I have the ability to go up the food chain, so to speak, make sure that I get in touch with the right managers to get things expedited if they need to be expedited. As a mortgage broker, you don't have that. And I can tell you, I've brokered some loans, not anything in the past 5 years. It was horrible. I'm a control freak. Why? Because realtors demand a control freak. Why? Because your clients demand you to be control freaks. I mean, think about it. When your clients are asking you questions, they're really not asking, they're telling you, I need to have this done on such and such date. They don't care about anything else. They don't care about mark-to-market accounting. They don't care about non-QM. They don't care about underwriting is backed up, processing is backed up. They don't care. They want you and expect you to get it done. And so it's important that we have systems in place that can accommodate that to where, if it's reasonable, it can get done. If a client wants to close a transaction in 5 business days, probably going to be tough unless they have cash, and then they don't need me in any case. But we want to make sure that we certainly do accommodate those. So I know today Jennifer had asked me to speak on really the different types of loans, just kind of do a pretty generic overview of what conventional financing is. So are all of you familiar with the term conventional financing or conforming loan? Everyone kind of familiar with that? So again, a conventional loan is going to be one right now in the areas that you are going to be working in. Most of the time, it's going to be loan amounts all the way up to $647,200. That's quite a bit up from where it was when I first started. But keep in mind that that's not the limit. That is going to be the loan limit, not the sales price limit. There are other ways for people to go higher than that. Oftentimes when people are buying a loan or buying a home, they might do a conforming loan at that $647,200 and then do a second lien on that home in order to bridge the gap to that purchase price. Are you all familiar with specifically what a second lien does and kind of how it's different from a first lien? 80-20 is the one that was out there for a long time where people didn't put any money down. 80-20s now are gone. You do have what are called 80-15-5s. That means that basically the first lien is going to be 80%. The second lien is going to be 15%. And the buyer is going to put 5% down. So you have that second lien in the 15% category. So what in essence that means is that that second lien is truly in the second lien position. What does that mean? If the house gets foreclosed upon, they are second in line to get paid. So the first lien position means first in line. House gets foreclosed, first lien completely gets paid out. Second lien gets paid out of whatever is left, the residual. So what I saw back in 2007, 8, 9, and 10, when we had the foreclosures going on and everyone was doing those 80-20 loans, here's what happened. Let's say there was a house for $100,000. The buyer did an 80-20 on that. They took out a first lien for $80,000 and a second lien for $20,000. House goes into foreclosure. So the house worth $100,000 sells for $90,000. After that, there's some expenses there. Realtors have to get paid. Let's say that the net proceeds are going to end up being, let's just say $82,000. That means the first lien company says, hey, I have a lien on this property for $80,000. Title company gives them a check, $80,000. Second lien company says, I have a lien on this property for $20,000. Check, $2,000. Because the net proceeds were only $82,000. So second lien companies have more risk than first lien companies. So the interest rates are always going to be higher on second liens. But it is a good way to structure a loan to sometimes avoid monthly mortgage insurance. Mortgage insurance is certainly something that most people try to avoid. And in the environment that we're right now, if a client comes to you and they're like, hey, listen, right now, I can max out the conforming loan limit of 647. What homes are available to me? Well, yes, we can find homes. However, there's a lot of homes that are going to be over that price point now. And so how are they going to get there? They can either bridge it with their own down payment money. They can come up with a second lien. So there are some ways to do that. Now, keep in mind with the conventional loan, you don't have to put 20% down. In fact, there are some conventional loans out there where they're geared toward first-time home buyers with just a 3% down payment. Now, most of the time when I see people doing conventional loans, typically they'll come to me and they'll say, Marcel, I can only put down 10%, or I can only put down 15%, or sometimes they can put down 20%. But in the market that we're in right now, I let them know it's going to be better to actually come in with an offer with lesser money down and save some of that money to make up the appraisal gap. So for example, let's say that you are working with a client, they want to buy a house for $70,000, or excuse me, $700,000. And they have 20% to put down. They have $140,000 to put down. So your thought is, hey, let's go ahead and write this up and we'll do 20% down. It shows that the buyer is really, really strong because they have that $140,000 to put down. But the listing agent's like, you know, we've already got 62 offers on the house. 30% of them are well above 15% over list price. So how are we going to do this? Well, I can then talk to the client and let them know, hey, I know you have this $20,000. Here's what you can do. Instead of putting down your 20%, why don't you just put down 10%, put down $70,000 on this property, and that gives you a cushion, an appraisal gap of $70,000 that you can then use to pay over and above market value. It finds a solution for the client. Go ahead.
If the appraisal gap doesn't end up being that big, can they come back later and increase their down payment
Absolutely.
before closing?
Absolutely. We can go ahead.
No, I was gonna answer her, then I have a question.
Now, we can certainly do that. We can make all sorts of adjustments on there. And so oftentimes, you know, listing agents right now are asking if they have the money to do that. We certainly, if a client has the ability to do that, when I'm reaching out to the listing agent, I let them know, well, on this client, they have the ability to put down 20%. The reason that they're reflecting a 10% down payment is because they're keeping funds available to cover any type of appraisal shortage. And listing agents love that. Why? Because they know that there's a possibility that there's going to be that appraisal shortage. And so now they're going to be less hesitant over that 10% down offer, because they know that the reason it's 10% down is because the client wants to basically make sure that they have money to cover any type of appraisal gap. To me, that's a stronger offer than someone who comes in with a 20% down offer and says we have no money to cover the appraisal gap. Basically, the only way we qualify is with 20% down, maybe debt to income ratio wise. You know, it might be that they can't do anything without that large down payment. And so it's really, really important to work with your lender and make sure that the client and the lender are on the exact same page, because when we reach out to the listing agent, it is so important to convey the strengths of that client, especially if they have the ability to cover any type of appraisal gap, and let them know that, hey, listen, this client knows what they're doing. They're doing 5% down, 10% down in order to basically make up any type of appraisal gap.
Have you seen those gaps now shorten?
Not yet. It really is going to depend. I can tell you that right now we have seen mortgage applications slow down a little bit, but I can also tell you that that is the natural reaction anytime interest rates jump. I've been doing this since 1998. Anytime that mortgage interest rates jump, the first reaction is everything kind of pause.
For how long?
A couple weeks.
Long enough for them to realize that they're not coming down, and
Yeah.
continue to go up. Because everybody
Absolutely.
who paused does not come back into the market at a lower rate. They come back into the market at a higher rate.
Yep.
Because people, how many times have you heard me say this? People don't like to make decisions.
Mhm.
So they go, oh shit, something changed, and they sit on the sideline. And when then they realize rates just creeped up another 1/8%, and they're not coming back, and their loan officer goes, dude, we're probably gonna be doing this again on Monday, and it's gonna go up another 1/8.
Mhm.
Then they come back into the market. The problem is people won't have bold conversations with them. People won't look at the seller and say, yeah, this is what we've been talking about. Right? The fact of the matter is most salespeople don't like to have bold conversations at all. Because if we like to have bold conversations, we wouldn't sit on what Marcel just told us. We would hop onto our phones and text 300 people and say, now more than ever, right? We've got the opportunity to compete with cash. Ask me how. And then you just go, oh my God, talk to my boy Marcel, man, that guy will get you squared away. He'll get you underwritten. He'll have it all lined up. He'll call that listing agent for you.
And that's what I was gonna mention, is that Marcel will call, and that's a huge advantage.
Marcel's called people before the offers even gotten to him. I know because he's done it online and he
But
beat
he's
my
gonna
offer.
call
Yeah.
and tell that listing agent why he structured the loan the way he did. If you just send over an offer from rando lender and it's got 3% down and no proof of funds or whatever with no phone call, they're gonna throw it in the trash.
Mhm.
But if Marcel calls and he's like, hey, we structured this way and they do have proof of funds and here's why and here's where we want to put it, et cetera, et cetera.
And it's really important to do so, but we see this every single time that interest rates jump up a little bit. All of a sudden, there's a pause. And then everything comes rushing back in because people are shocked. And then, like Kevin said, then they realize, you know what? It's not going to get better in 2 weeks. It's not going to get better in 3 weeks. It's not going to get better in a month. And then all of a sudden they're like, well, I still need a house. And so,
Or they give
Just
you,
a small
I'm gonna
one.
wait till they go back down, and you go, well, the last time they were this low was never,
mhm,
never. Where they were 2 years ago, they have never been in the history of interest
No.
rates. And the underlying organization that determines the government rates has said, if we can raise it 5 more times, we are going to.
mhm.
Not like,
And not just small bumps. They're talking about 50 basis points.
and understand, you just had the fastest rise in a century on a 2-week period. That's the fastest rise. The last time we saw anything like this was 1994. The underlying government rate at that time was around 4 to 5%, depending where it sits. That's the underlying rate. Remember, Fed rate does not automatically correlate to mortgage interest rate, right? It does not just automatically go up by the exact same token, if you will. There are other factors that come into it. So that was 1994. Do you know how many homes were sold between 94 and 95? Like what massive drop occurred in the market? 11%. Literally, it had an 11% effect that lasted less than 7 months.
Mhm.
That's it. That's nothing. That's negligible. Considering last year was the highest number of homes sold in the history of the United States of America.
Mhm.
If we had 9 to 11% disappear for 7 months and come right back, we wouldn't even notice it,
Nope.
right? They'll notice it in little short spurts like you are right now.
Mhm.
Rate, new home, new applications for mortgage origination have stepped back a little bit, but they'll come right back. And you've done this long enough.
Absolutely. It'll last a couple weeks and then people are like, we
Well,
still need a house.
Do you know what they will do though? They'll go, well, I guess we're not doing Liliana. They'll say, well, I guess Prosper's out and Melissa's in. They will do that eventually because they'll have to. Right now is a great, right now is a great opportunity to be in the conversation with buyers. We're going to talk about that in a little bit. You've got to be in the conversation with the buyers. And I don't mean like the people that call you. I mean, you need to be going and finding the motivated, right? If I had 80 people in my brevity, I'd message that I haven't spoken to, I'd message all of them and say, have you lost out on an offer already? Are you looking for the golden ticket to make sure you can get that next one that competes with cash and still take advantage of the best interest rates available? That's all you got to say. When they call you, you just go, oh, this is a no brainer. I need you to talk to my guy.
This is 100% the reason why you should have your clients for new construction reach out to Marcel. Don't just go, well, they're gonna go with the builder's lender for now and they'll figure it out later. They might need help now for later, right? They might need that long lock, or they might.
And that's every conversation I'm having right now with people that are getting under contract for new build. I'm having them to talk to the builder's lender and get that locked in. Create your worst case scenario, because you don't want to have someone under contract, interest rates go up, and then they don't qualify for the
Well,
house.
that's exactly what's happened to several of my clients, is they contracted when interest rates were at 3.5%, 4%, and now they've taken such a jump that they can't afford the house. Well, it's not, you can't afford the house. It's maybe you can't afford the house with that lender. Let's talk to Marcel, see if he has a creative option and move forward that way.
So I have a question about using an outside lender. Do all the home builders allow that? Obviously, I've not dabbled in that at all. So they prefer you to use theirs, but you can use whoever you want. Is that how that works? Okay.
They might offer a different incentive for using theirs. Don't let that dissuade you as well.
Okay.
Still call Marcel, tell your client, say, I think it's to your benefit to have them compete for your business. He might be able to match it or beat it.
And you know, at the end of the day, there's 3 outcomes that happen. Let's say if you have a client and they talk to the builder's in-house mortgage company, and then they talk to us, 3 things can happen. Number 1, let's say that their in-house mortgage company has incentives that can't be touched. Well, what they've done then is, because they've talked to us, now they've solidified their intent to buy that property, because they're like, we're getting a smoking deal from the builder's mortgage company. I can't believe no one can touch this. Now they are more solidified in that buying process and going to be less likely to have any type of buyer's remorse. The second thing that can happen is, let's say that we're able to do just a little bit better. Let's say we can save them $2,000, $3,000, $4,000. then they typically go back to the builder's mortgage company and say, hey, this is what we can get, with guaranteed rate. Is there anything you can do? Oh yeah, we'll go ahead and match that. Now you just saved your client $3,000-$4,000. They're happy about that. Or let's say that we're able to do something completely astronomically better than the builder's in-house mortgage company. Then they're like, I am so glad I didn't go that direction, because this saves me on cash to close. It saves me on interest rate, monthly payment. Overall, I can't believe we almost went in that other direction. So of all three outcomes, there's really not one that is going to be negative for your client. Because with your client, again, it's either going to be they're solidified in their decision because they're getting a smoking deal, or we can do just a little bit better and the in-house mortgage company matches that. Now you've saved your client a couple $1,000s. Or maybe we can do a lot better and then obviously save your client on monthly payment, cash to
All
close.
my clients where Marcel or his brother Jan will call us and go, yeah, I can't do that. They need to stay where they are, right?
And that's not a bad phone call, because that solidifies your buyer. It makes them more emotionally happy about the purchase. And it means that they're also going to be more likely to refer family and friends because they're excited about it. They feel like they got a great deal.
Can you talk about your team? Who calls if you're not the one calling?
Certainly. So with my team, I'm always going to be the first person who reaches out to answer any questions for you or your clients. After they've applied, I have my brother Jan, who is my loan partner. He is excellent at putting numbers together. We work with a lot of international clients, sometimes engineers, who love to have like 15 different estimates put together. He loves it. That is my brother's personality. He's very, very good at kind of doing that. And so he is great at kind of working with clients, selecting the best program, looking at which program is available. And so Jan is typically going to be, and we were both born in Germany. My mother was studying languages, so I got a French name, Marcel. He got a Dutch name, but growing up with a name like Jan has been really tough, I guess, for him over the past 40 some years. But so he is really my key point. Then I also have Trisha. She is been with our team now for, I want to say 12, 13 years. She's my production manager. She's the one who makes sure that everything is going smoothly. We have a front end and back end processor on the team. It's a little bit different format than most mortgage companies do. The problem with most mortgage companies and the way that business has been done for like probably 100 years is that you have a processor and they're either in one of two phases. The first phase is they got a ton of business in, and so they're working on all that, and so the transactions that are about to close don't get enough emphasis, they don't get enough viewing, and all of a sudden those transactions are closing late. And you've probably experienced this before, to where you're like, hey, well, we got everything in like months ago, and why is it that we're having problems right now at closing when this was all started a long time ago? And that's because most mortgage companies structure it with one processor. Or the other thing that sometimes happens is that too many loans are closing at the end of the month. And so the processors are hyper-focused specifically on those end of the month closing. And then your clients have turned in documentation and it doesn't get looked at for like 2 weeks or 3 weeks.
Me personally, it was awful.
And so the format that Guaranteed Rate uses is very different. So we have a front end and back end processor. The front end processor, their responsibility, look at the stuff fast, get everything squared away, make sure the T's are crossed, I's are dotted, and then it goes into underwriting. Then we have a back end processor. Their responsibility is make sure you hit the closing date. Make sure that any conditions that come out of underwriting are taken care of quickly, coordinate with the insurance company, get all that squared away. So by having a processor on both sides, it kind of solves the problem that most mortgage companies have, in that the underwriters sometimes feel like they're being pulled in two directions. Should I review these documents, or should I make sure that this loan closes on time? Well, with us, we kind of have that solved by having a processor on the front end who is graded on how quickly they get through everything. And then the back end processor is also graded on how quickly they go from having a clear to close to actually having the docs and everything out. And so that's kind of the basic structure of my team. I also have Nick on my team. He's a younger loan officer, extremely bright. He is awesome. And so Nick on my team, he's also very, very good. He kind of is on our team almost like a shortstop. And so he fills in if I'm not available for something. Like if right now, let's say leads are coming in and I'm not able to reach out. Nick will go ahead and jump on that, or if Jan's gone, Nick is also completely capable of kind of putting all that together. And so our goal as a team is to make sure that we're very, very quick to acknowledge. And that's really our focus this entire year is speed to acknowledgement. When you have a client and that client needs to be called, has a question, is our team structured to where we can answer those questions quickly? Yes, because a lot of my typical duties have been taken off my plate. So it allows me to answer questions for realtors. It allows me to answer questions for your clients. And so I want to be there. Why am I able to do that? Because I'm not the one who's actually going through the bank statement. I'm not the one who's going through the tax returns. There's people that are highly skilled at those tasks who are doing that. And so it ends up kind of functioning well.
You want to
What-
share your phone number about that?
Absolutely. 972. Actually, it's on the book.
Oh, yeah, it is.
672.
Yeah, 972-672-3246.
This is your cell.
It is.
All these guys have to hop on a team meeting.
Okay, everyone has to hop on the team meeting, but this Friday we are having GR Palooza. It's kind of like a party at the windmills over in the colony. I believe I've sent out a lot of invitations, but I'm going to be sending that out